Do you trust data? Or more specifically, can you trust data when it's telling you something that's different from what you know, from what you've experienced in the past, from your gut? At what point can we look at data that's telling us something that we don't expect it to tell us and say, okay, I'm going to change my thinking. I'm going to change my strategy. I'm going to trust that the data is telling me something important. Now, as we go into 2025, that question is even more important because the world is changing and it is uncertain and we don't know where we are going. It seems to me that in 2025, we need to take a good, hard look at how much do we trust the data that we're being given.
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
So we're talking today with Sabrina Unger, who's the managing director and head of research and strategy at American Realty Advisors, and really one of those people that I turn to give that more detailed, nuanced understanding of what's actually going on. So I'm really glad, Sabrina, that you're able to join us in the AFIRE podcast today. Thank you.
Yeah, thank you for having me.
Well, I guess, why don't we start out with, we're here at the end of 2024 and trying to figure out what's going to happen in 2025, especially those things that maybe we're not expecting, that might be counter to what everyone is saying they think is going to happen in a time of change, in a time of volatility. So as you're thinking about that, what are the markets that you're focused on that you think are going to be the big wins in 2025?
Yeah, so I'm gonna flip it on its head a little bit and say something a little provocative, and then I'll give the caveat, of course, which is, we're thinking about it from the perspective of, do markets matter, right? Or maybe markets don't matter, maybe is the better way to say it. And
okay,
the way that I think about it is, historically, those of us on the fund management side, thinking about our investors, have really thought about diversification and the potential to outperform at the market level. So that gets really to your question of which markets do we think are best positioned to outperform. And there are certainly going to be variation in fundamental performance in 2025 when we think about a sector like multifamily, for example.
Right.
But in the past, it was sort of enough of a distinction if you were a multifamily investor to say, I feel good about making an investment in Denver, and I'm going to avoid making an investment in Detroit. And that was satisfactory enough. You were getting relative outperformance by making that decision. But it is my view, as we enter 2025 and think about where we're going to be making new investments, that market selection as a driver of relative over or underperformance may actually be reduced relative to some of the other levers that we have to pull when it comes to making sort of geographic selection within a sector.
I'm hearing that a little bit from folks as I go through the membership. There is this kind of drive towards more of a granular strategic thinking. In other words, the property itself matters, where it's located, the submarket forces, what's happening there, stuff that's a little harder to get into. It's not something that we can put on a map in a report on, one market is bad, another market's good, stay in the good market. What I find interesting about market selection is that so many investment managers that I sit down with tell me that they have a unique market selection approach, and then they talk about all the same markets that everyone else says is part of their unique market selection approach. So I think your question is a good one, and one that we should pay attention to. How much does that really matter?
When we look back over history, the dispersion between the best and worst multifamily markets, that dispersion is the widest during periods of adjustment. So when we look back over time, the widest dispersion was occurring during the global financial crisis, the supply surge in 2016, and then during the pandemic, we saw that gap really sort of widen out. But outside these periods, market fundamentals, so we're talking about rent growth as sort of the metric here, it tends to cluster much closer together. And anybody who has downloaded any third-party data providers, 3, 4, 5-year rent growth forecast, there's actually fairly minimal difference, best and worst. And so how do you create outperformance? And I think there's certainly an argument to be made that in 2025, the gap may be a little wider than normal, just because markets are working through some of that oversupply that's delivered over the last 2 years. But again, when we're making investment in 2025, we have to have the perspective of the entire hold period, not just how a market's going to perform in 2025, especially on the private side, because we're not coming in and out of a market monthly or quarterly. Our business plan is, 3, 5, 7, even 10 years.
And that sometimes I think is the hardest thing to keep in mind, that the institutional investor has a longer time horizon. Therefore, whatever's happening, the noise, if you will, from year to year, needs to be, at the very least, we need to be skeptical about it. We need to resist the pull to overreact one way or the other. I do find it interesting that so much of what was happening during COVID, or at least what people said they were doing, is that they were moving from expensive markets to less expensive markets because it didn't matter where they were physically. And yet, if you look at those markets they were going to, the pricing very quickly adjusted to the point of, where is the cheap market? Those markets have become farther and fewer. And it seems like every market, whether you're in the middle of Montana or you are in New York City, seem to be pretty close in price. So that certainly supports what you're saying, that the differences are not maybe as great as we sometimes assume.
Yeah, and I think from a variability and a data point perspective, when we look at rent growth, absolute best performing multifamily market, absolute worst. On average, the basis point spread in rent growth in a given year on average is about 400 basis points. So that's not insignificant, right? It does matter to some degree whether, like I said, you're going into a Denver or a Detroit over your full hold period. But when you look at the dispersion of best and worst submarkets in the same set of markets on average, same time period, it's 870 basis points difference on average between best and worst. So that is the potential to effectively double, your dispersion, the opportunity to sort of get it right. And so that's why we've really implemented a submarket targeting strategy throughout our funds. We have a new thesis that's based on this approach, that's sort of saying the market narrative may actually be disguising really strong submarket opportunities, and there's a way to take advantage of that arbitrage.
Do you think part of this realization and the ability to go granular, because data is becoming more granular? I mean, I think to a certain extent, real estate, we tend to use broad heuristics to define where the opportunities are, or at least we've done that historically.
Yeah, I think, a lot of us are subscribing to the same third-party data providers. So whereas, 20, 30 years ago, the differentiation between manager performance was whether or not you had access to data. Now we all sort of have access to the same set of data. And so the advantage comes in, how are we applying it, dissecting it, interpreting it? There is a greater appetite to bring in a lot of data. There are new tools that are making us much more effective at processing and synthesizing it. I think a lot of us are really leaning into how can we use AI effectively to supplement our team's abilities and our on the ground perspective. And so I think we're really lucky in the United States because we have so much data available to us compared to other global markets, and that allows us to dig in deeper.
It seems like a lot of the battle is between, those of us that invested in one environment, then moving into a new environment where this is a new input, this is a new way of thinking. How do you see various investors kind of taking that jump, moving into understanding data as an important and essential tool for them to find alpha?
Yeah, I think it's twofold, the trust element. There is the first question, which is how much validity do we put in the raw data that we are looking at? Do you have to have input data that you have some degree of conviction and trust in? Then it's about socializing it internally and challenging long-held belief on markets. If you got burned in a market 15 years ago, you're going to be hesitant to go back in, even if all of the data is suggesting actually something has fundamentally changed there. And so I think that comes with having internal support and buy-in, at least with the idea of exploring what are the takeaways from the data? How can we validate it ourselves? What are we seeing that could challenge what the data is saying? Because I know that there's a concern in our industry, and I think this is most industries, that you're going to feed all this data into an AI machine and it's going to spit out something and we're going to follow it blindly. And the reality is there's a reason real estate is still sort of a people business. We still have to challenge and test and hypothesize what could this be missing, or what does our experience suggest maybe a qualitative input that can't come into this modeling. So I think there's two functions of how do you get to trusting the output of this, more granular, data-rich environment. I think it's, trusting the data quality that's going in, but then also, sort of challenging and trusting internally, having that buy-in.
It certainly feels like real estate is now in a frontier that includes science in our thinking. And that is exciting and interesting and is going to be challenging behaviorally, as well as just how do we make sure we're using these tools appropriately. And it's just becoming more important as AI is starting to intrude on every aspect of our lives. So thank you so much, Sabrina, for bringing a little bit of thought here, and have a great 2025.
Thank you.
You have been listening to the A5 podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. A-Fire is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though A-Fire is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of A-Fire.